Have you ever seen the news about a massive corporate merger, like Disney buying Fox or Microsoft grabbing Activision, and just wondered, what really happens next? Not in the press conferences, but on the actual financial statements. You'd think it would be simple, right? Just add column A to column B. But it's way, way more complicated than that. And to make sure investors all around the world can actually compare companies fairly, apples to apples, there's a very specific global rulebook that everyone has to play by. And that playbook is called IFRS 3. This is the official guide that lays out exactly how to account for these huge company-changing deals. It's all about making sure the financial story they tell is reliable and consistent, no matter where on the planet the deal went down. All right, so here's our game plan for the next few minutes. We're going to break down what a business combination even is. We'll look at the one and only accounting method you're allowed to use, see how everything gets valued, unlock the magic of goodwill, and then we'll quickly touch on what happens long after the deal is done. Okay, first things first. Before we dive in, we've got to make sure we're all speaking the same language. So let's start by defining some of the key ideas that IFRS 3 is built around. Now, these rules didn't just pop out of thin air. They've been evolving for decades. The original standard came out way back in 1983. But the really big shift, the one that totally changed the game, was in 2004 when IFRS 3 came along. Every update since then has just been about fine-tuning things to make them clearer and more useful. And that brings us to the main event, the business combination. The two words to focus on here are control and business. This isn't just about buying a warehouse full of stuff, it's about one company gaining control over another actual operating business. In every single one of these deals, there is a buyer. IFRS 3 calls this company the acquirer. Simple enough, they're the ones acquiring control. And of course, if you have a buyer, then you've got to have the acquiree. That's the business that's being bought. Acquirer and acquiree. Easy enough? Now that we know the players, let's look at the rules of the game. So, how does IFRS 3 say the acquirer should account for this new business? Well, the standard is super clear on this. There is only one way to do it. It's called the acquisition method. And this method is basically a four-step dance. First, you identify the acquirer. We just did that. Second, you pinpoint the exact date control changes hands. Third, and this is a big one, you have to recognize and measure everything you just bought. And fourth, you calculate something very special called goodwill. We're really going to focus on steps 3 and 4. So let's get into it. How do you actually measure all those assets and all those liabilities from the company you just took over? What are they really worth? The standard has one single, crystal clear guiding principle for this. Everything, and I mean everything, from factories and patents to customer contracts and debt, is measured at its fair value on the date of the acquisition. This is a huge deal because it's a total reset from whatever was on the old company's books. So what on earth is fair value? Well, think of it like the current market price. It's not a historical number, it's not a wild guess, it's the price that willing and informed buyers and sellers in the market would agree on for that thing today, on the date of the deal. It's an outside-in look at value. Of course, this is accounting, so there are always exceptions to the rule, right? While fair value is the main principle, the standard has very specific instructions for some really complex stuff like income taxes or leases. For those, it actually points you to other IFRS rulebooks for the nitty-gritty details. All right, now we get to the most fascinating and honestly the most misunderstood part of any acquisition: goodwill. This is where we have to put a number on things you can't even see. So here's the puzzle. Very often, when a company buys another, the price they pay is more than the fair value of all the individual assets they get, minus the liabilities. So the question is, why would a smart company knowingly overpay? Well, the answer is, they're not overpaying. They are paying for goodwill. This is the value of all the things that you can't put on a spreadsheet. We're talking about the power of the brand, the loyal customer base, the brilliant team that's already in place, the synergies you hope to create. It's the premium you pay for the future potential of the business. And the math behind it is surprisingly straightforward. You take A, which is the total price the acquirer paid. Then you subtract B, the net fair value of all the identifiable things they got. Whatever is left over, that premium, that is your goodwill. And it gets recorded on the new balance sheet as an intangible asset. But what if the opposite happens? What if you manage to pay less than the fair value of the net assets? It's rare, but it happens, sometimes in a forced sale or something like that. This is called a bargain purchase. And instead of recording an asset, the acquirer gets to recognize an immediate gain in their profits. It's like finding a priceless antique at a garage sale.
You know, the work doesn't just stop the day the deal is signed. IFRS 3 also gives us the rules for what happens next as these two companies start their new life together.
So after the deal, all those assets you bought followed their own specific accounting rules. But goodwill is special. It isn't slowly written down. Instead, it has to be tested at least once a year to see if its value has dropped. The rules also give companies a measurement period of up to 1 year to finalize all the numbers. And most importantly, they have to disclose a ton of information so investors can see exactly what happened and why. And every one of these detailed rules all comes back to this one core objective, stated right in the standard itself, to make the information more relevant, more reliable, and more comparable. It's all about building trust in the numbers.
So here's the bottom line. IFRS 3 isn't just a technical exercise for accountants. It is a framework that creates a common language. It allows investors, analysts, and really anyone to look at a massive, complex merger and understand its financial impact in a clear, consistent way. It's really a foundation of trust for our global markets.
So the next time you read about some multi-billion-dollar acquisition, go and find the financial reports. Look for that goodwill figure. Because now that you know the rules, you can ask yourself a much smarter question. What does that number really tell you about the story that company is telling the world, about the price it was willing to pay for the future?